All right, let's talk about the elephant in the room. The biggest IPO in history is just around the corner, SpaceX. But there's a huge catch. To pull off something this massive, you need a blazing hot bull market. So why on earth are tech stocks falling? Well, today we're going to dive into a pretty wild theory that says this whole downturn isn't a crisis at all. It's actually part of the plan.
And that's the big question, right? Is the market really ready for this beast of an IPO? I mean, with all the volatility we're seeing, can an offering this huge actually work? At first glance, the timing looks, well, it looks awful.
But Elon Musk needs it to be ready. And this is where the whole story just gets fascinating, because the theory goes that for a deal this important, you don't just sit around and wait for the perfect market conditions. No, you go out and create them. So let's get into the SpaceX Gambit. Look, this is not just another company hitting the stock market. We're talking about a genuine market-shaping event. And the strategy behind it? It seems just as audacious as SpaceX itself.
To really get what's at stake here, you have to appreciate the sheer scale of this thing. The SpaceX IPO isn't just trying to break a record, it's aiming to nearly double the previous one. Think about that. To soak up that much stock, you need a literal ocean of buyers, all with their cash ready to go. And that brings us right back to the paradox. You need a bull market for a sale this big. So why are tech stocks dropping? It just doesn't make any sense. Unless, of course, this isn't just some random dip. Unless it's a carefully calculated move. So here's the theory. Big institutional funds are selling off their other tech shares on purpose. They're not panicking. They're making room. They're freeing up cash so they can get a piece of SpaceX. And get this, at the same time, there are reports that legislation was actually changed to fast-track SpaceX into major indices. That would guarantee a tidal wave of institutional money from day one. So you see, it's not a crash. It's a planned rotation. But that big institutional play, that's only half the story. The other half involves something pretty crazy. A huge, unprecedented slice of the pie for everyday investors like you and me. And let's just say the reason for it probably isn't generosity. 30%. Just let that sink in. A full 30% of the biggest IPO in history is supposedly being set aside for retail investors. A number like that, it's basically unheard of. I mean, just for some context, most big IPOs, they set aside maybe 5–10% for retail. SpaceX is offering 3 to 6 times that much. So is this just a nice gift to Elon's army of loyal fans? Well, this analysis we're looking at suggests it's something way more strategic. Okay, so here's how the strategy apparently breaks down. First, you whip up all the hype with that massive, super loyal fan base. Second, you lock in a huge guaranteed block of buyers who are, let's face it, emotionally invested. And third, and this is the really clever part, you bet on the fact that retail folks tend to react a lot slower to price drops than the big institutions. This creates a kind of buffer, a stabilizer, to stop the stock from tanking right out of the gate. Okay, so when you put those two pieces together, a planned rotation by the big guys and a retail base designed for stability, it all starts to point to one thing. What we're witnessing in the market right now isn't the start of some catastrophic collapse, it's a controlled correction. And yet, what do we hear everywhere we turn? Big players like BlackRock are sounding the alarm bells, right? They're talking about a market collapse, and that's creating a whole climate of fear. But if this theory is right, all that fear is completely misplaced. What we're seeing isn't a crash. It's a classic technical move, a Fibonacci 0.382 correction. Now, I know that sounds like a bunch of jargon, but it's not a signal of disaster. Think of it more like the market just taking a healthy breath after a really long run. It's a predictable pullback before the next big move up. But hold on, that brings up a really important question. Global liquidity, the amount of cash sloshing around the financial system, it's actually shrinking. A big reason for that is high energy prices pulling money out. So if that's happening, what's the safety net? What's stopping this controlled correction from spiraling into a full-blown crash? Well, the answer, it seems, lies with the Federal Reserve, and they are in a serious bind. The economy's growing and inflation is high, so they can't lower rates. But oil demand is what we call inelastic. People have to buy it no matter what. So they can't really raise rates either, because that would just crush the economy without actually solving the energy price problem. That leaves them with pretty much one option: keep pumping liquidity into the system. And that right there is the safety net under the market. And this is where it all comes together. This is the final and maybe the most important piece of the puzzle. Because those high energy prices we just talked about, They aren't just some random market factor. No, they're the backdrop for a much, much bigger geopolitical fight. So you have to ask, where are these high energy prices hitting the hardest? Just follow the oil. The main destination for the world's most critical supply is Asia, and according to this theory, that is absolutely not a coincidence. The goal, this analysis argues, is to inflict as much economic pain as possible on one specific target, China, and that whole surrounding ecosystem that's basically become the world's factory. Yeah, forget tariffs. The new weapon in this economic war is energy. By jacking up the price of oil, you're taking a direct shot at the very foundation of China's manufacturing power. And the reported impact? It's been absolutely brutal. A full quarter of their industrial sector is supposedly now operating at a loss, and the companies that are left are surviving on razor-thin margins. So when you step back and look at the whole picture, all these things that seemed totally separate, a massive IPO, a dip in tech stocks, a global energy crisis, they start to click together into one single cohesive story. Let's just connect all the dots one last time. You've got the SpaceX IPO using that big retail allocation to create stability. It's happening inside a controlled market dip, which is only possible because the Fed is providing that liquidity safety net. And the whole thing is happening under the cover of high energy prices, which are themselves a weapon being used to weaken China's industry. You see, each piece of the puzzle makes the next one possible. So there it is, the whole theory in a nutshell, a market correction, perfectly engineered to launch the world's biggest IPO, all happening under the fog of a global energy conflict that's serving a much bigger geopolitical agenda. Which really just leaves us with one big question to chew on. Is the market truly some force of nature guided by an invisible hand? Or is it really just a chessboard for global powers to play on? Thanks for diving into this with us.